Thanks for joining us for the September 2018 survey results of the Purdue University CME Group Ag Economy Barometer. I'm Jim Mintert, Professor of Ag Economics and Director of the Center for Commercial Agriculture at Purdue. And I want to share with you the results from our most recent survey of the Ag Economy Barometer. The barometer declined significantly this month to a reading of 114 from a reading of 129 a month ago. It's the second time in the last 3 months that we've seen a sharp decline in the barometer as financial conditions in the ag sector have deteriorated. The decline in the barometer this month was driven both by a decline in the index of future expectations, which fell to 122 from 132 a month ago, and especially a decline in the index of current conditions, which fell to 96 from 121 a month ago. That was one of the largest declines in the index of current conditions we've seen since we started collecting data in the fall of 2015. As you look at some of the individual questions that we posed to compute the barometer, when we asked people would they say that their farm operation today is better off, worse off, or about the same compared to a year ago, the percentage of people saying worse off jumped from 47% to 54%. And as you look at that data, notice that that's the worst reading we've had in well over a year with respect to the percentage of people saying they were worse off than a year earlier. Turning to the general ag economy, that negativity we saw with respect to individual farm operations spilled over into perspectives on the general ag economy as the percentage of people saying that they expected to see bad times in the U.S. ag economy in the next 12 months jumped to 69% from 52% a month ago, with very little change in the percentage of people saying that they expected to see good times. We always ask people about large farm investments with respect to especially buildings and equipment, and we ask whether or not they think it's a good time or a bad time to buy such items. The percentage of respondents saying it was a bad time to buy those items jumped to 78% this month from 65% a month ago, and the percentage of people saying it was a good time declined to 20% from 26% a month ago. When we combine those two readings, both the good time and the bad time readings, into a single index, the index of focused on machinery and building investments, it gave us the lowest reading we've had since we started collecting data in the fall of 2015. We continue to ask people about the impact of trade conflicts on their farm's income. This is the third month in a row we've posed this question. And we've really seen very little change. If you look at the data in July of 18, 71% of the respondents said they expected to see an income decline of 10% or more on their farm operation because of trade conflicts. That moderated a bit in August to 66%, saying that they expected to see a decline of 10% or more. And then this month went back to essentially where it was in July at 72%. So people are still concerned about a significant income decline related to the trade conflicts. For the second month in a row, we asked people about whether or not the relief plan from USDA and President Trump's administration was going to have relieve their concerns about the impact of tariffs on their farm's income. And for the second month in a row, we had very little change. If you look at the data for August versus September, very little change with respect to the responses we received. The negativity with respect to farm income led us to ask questions about farmland values and farmland cash rents going forward. And we've asked the cash rent question 2 months in a row now. In August, 65% of the respondents in our survey said that they expected to see lower cash rents a year from now. That changed very little this month at 63%. So roughly 2/3 of the farmers in our survey expecting to see a decline in cash rents over the next year. One of the commodities that's been hardest hit by the trade conflicts and the resulting tariffs has been soybeans. So we asked farmers that grow soybeans what their soybean storage plans are for this fall in light of the large decline in soybean prices that's taken place. 65% of the respondents in our survey said that they plan to store about the same percentage of their production as they usually do, but nearly 1 out of 5, 18% of the respondents in our survey said they plan to store a higher percentage of their production than they usually do. We also asked people that are going to store the same amount of their soybeans or more of them than typical, what they plan to do with respect to selling those soybeans. 46% of them said that they plan to store most of their soybeans until the trade conflict is settled with China. That wraps up our discussion of the Purdue CME Group Ag Economy Barometer. Our next barometer will be released on November 6th of 2018, and our next Ag Outlook webinar will take place on December 19th of this year. If you want more details on the report, go to our website, purdue.edu/agbarometer, and you'll be able to download the entire report along with all the charts included. Thanks for joining us. On behalf of the Purdue Center for Commercial Agriculture, I'm Jim Mintert.